Hello people, welcome to the YouTube channel Free Management Education. Today we will discuss about the various capital budgeting techniques, and this is the second part of the video series of capital budgeting techniques. Okay, in the first part the NPV and IRR are fully covered. So in this lecture we will cover profitability index, payback period, discounted payback period, modified internal rate of return and accounting rate of return. Okay, so let's start with the video. So what is profitability index? Okay, so it is the ratio of present value of cash inflow at the required rate of return to the initial outflow of the investment. Okay, that is the ratio of the present value of cash inflow at the discount rate or the required rate of return to what? To the initial cash outflow of the investment. That is the initial investment. Okay, so it is also called the benefit cash ratio. It is used to rank projects. Okay, so PI refers to the productivity of capital in terms of present value of cash inflows per unit of capital outlay. Here outlay is the investment. Okay, so it is the ratio of PV of the present value of cash inflows by initial cash outlay. Outlay means investment. Okay, under situations of scarcity of capital, when that means when there is fund constraints, projects may be executed in descending order of profitability index. Okay, the profitability index, where it is high, it will be ranked first and then the subsequent rankings. Okay, so under the situation of scarcity of capital, projects may be executed in descending order of profitability index. So this is the formula, just go through it. Okay, so PI, profitability index, is a variation of the net present value rule. It is also a discounted cash flow technique. In the first part of the series, I have told about the discounted cash flow and the non-discounted cash flow techniques. Just go through it. Okay. Now the acceptance rule of PI. So if PI is greater than 1, then accept, and if PI is less than 1, then reject, and if PI equal to 1, then may accept. The projects with positive NPV will have PI equal to 1, and the projects with negative NPV will have PI less than 1. So merits of PI is same as that of NPV, like it considers the time value of money. Okay, that is why it says it is a discounted cash flow technique. It considers all the cash flows. It is consistent with the shareholders' wealth maximization principle. In capital rationing, we use the profitability. Now the NPV versus PI. Okay, in case of marginal projects, NPV will be 0 and PI equal to 1. Okay. Now the conflict arises when choice between mutually exclusive project has to be made. In such projects with same NPV, that is in mutually exclusive projects with same NPV, the one with lower initial cash outlay, okay, that is the lower initial cash investment, or higher PI will be selected. Okay, which is the higher PI that will be selected, or with the lower initial cash outlay or investment. Otherwise, higher NPV should be preferred except under capital rationing. That is the under funds constraint. Capital rationing means funds constraint. Okay, as net present value is consistent with the wealth maximization principle. The divisibility of the project implies full utilization of the capital budget, and there are no additional constraints on the acceptance of projects. That is what divisibility means. It means I am using the entire capital budget. Okay, that is the full utilization of capital budget, and there are no additional fund constraints. Okay, on the acceptance of projects. In such cases, PI would give optimum results. Okay, so when there is a divisibility of project, you should choose PI. In NPV versus PI, NPV rule gives better results because of indivisibility of projects. Okay, here during the indivisibility of projects, you should choose NPV. Okay, for mutually exclusive or indivisible projects, we will use NPV. Okay, the selection of projects on the basis of profitability index may prelude the acceptance of two smaller projects due to selection of projects with higher outlay. Okay, so two smaller projects may provide a greater increase in the aggregate NPV than a single large project. So in case of profitability index, we are choosing a project that has higher PI. Okay, but this causes a problem that a two smaller project may provide a greater increase in the aggregate NPV than a single large project. So this is one of the drawbacks of profitability index method. Okay. Now comes the payback period. Okay, so it is the number of years required to recover the original cash. Okay, original cash outlay, that is the original cash original investment amount, to recover the original investment amount invested in a project. Okay, it is the number of years required. If the project generates constant annual cash inflows, payback period can be computed by dividing cash outlay by the annual cash inflow. It is a non-discounted cash flow technique. Okay, that is, it doesn't consider time value of money. So payback is initial investment by annual cash inflow. The payback reciprocal gives a close approximation of IRR, or internal rate of return, under two conditions. That is, life of a project is large or at least twice the payback period, or project generates equal annual cash flow. If you see the first video of IRR, you will see that the IRR is the rate at which NPV is 0. That is, present value of cash inflow equals the present value of cash outflow. That's why it says the project generates equal annual cash inflow. Okay, equal. So the payback reciprocal, that is C by C naught. Okay, C by C naught is the reciprocal. Okay, so this is payback period. So it is the initial investment by annual cash inflow. It is the number of years required to recover the original cash outlay invested in a project. Next, the acceptance rule of payback period. If a payback period is less than the predetermined standard payback. What is a predetermined standard payback? Okay, the standard payback period is determined by the management in terms of maximum period during which the initial investment must be recovered. Okay, so this standard payback period is decided by the management itself, that the amount invested, it should be recovered within this span, within this time actually. So this is the standard payback period. So if payback period is less than the predetermined standard payback, then accept, obviously. And if payback period is greater than the predetermined standard payback, then reject. Okay, highest ranking the project with shortest payback period, and lowest ranking the project with highest payback period. Okay, obviously shortest payback period means the number of years is less to get the initial investment amount. If the firm has to choose between two mutually exclusive projects, okay, then the project with shorter payback will be selected. The merits and demerits of payback period. So the merits are its simplicity, it emphasizes liquidity, it's easy, okay, it's cost effective and uses cash flow information. The demerits are more important because it ignores the time value of money. It ignores cash flow occurring after the payback period. Okay, if there is uneven cash flows, it doesn't consider the cash flows after the payback period. No relation with the wealth maximization principle. This is the most important part, because the NPV, IRR, the profitability index, they all are consistent with the wealth maximization principle of the shareholders. It's not a measure of profitability. It's inability to handle multiple cash flows. Okay, no objective way to determine standard payback. That is, the management can be biased. Okay, so I have told you that the standard payback period, the predetermined standard payback period, is determined by the management itself. So the management can be biased, or there may be conflict between the management. So there is no objective way to determine the standard payback. Now the discounted payback period. Okay, so payback method does not discount the cash flows for calculating the payback period. Okay, that is, payback method was a non-discounted cash flow technique. That is, it ignored the time value of money. But the discounted payback period is the number of periods, okay, is the number of periods taken in recovering the investment outlay on the present value basis. That is, what is the present value of the amount, okay, that I have invested. Okay, so discounted payback period is the number of periods the years taken in recovering the investment outlay on the present value basis. This was not in payback period. It was not in payback period as the present value basis. Okay, the discounted payback period still fails to consider the cash flows occurring after the payback period. Okay, discounted payback period considers the time value of money, unlike simple payback. Okay. Now the accounting rate of return. So what is accounting rate of return? It is also known as the return on investment. It is a non-discounted cash flow technique, that is, it does not consider as a time value of money. Okay. ARR is given by average income by average investment. Average net operating profit after tax by average investment. Okay. So it is used in situations where companies are deciding on whether or not to invest in an asset. Okay, based on the future net earnings expected compared to the capital cost. Okay, in these types of situation, when the companies are deciding whether or not to invest, then ARR comes in handy. Here is an example. If the ARR is equal to 5%, this means the project is expected to earn 5 cents for every dollar invested per year. Okay, so it's simple enough. Thus, if a company projects that it will earn an average annual profit of $50,000 on an initial investment of $10 lakh, then the project has an accounting rate of return of 5%. You just put the values in here, you will get the answer. This example is just to clarify the concepts, okay, just to make the concepts more clear. Now the acceptance rule of ARR. Okay, accept the project if ARR is greater than the required rate of return or the discount rate or the opportunity cost of capital, and reject the project if ARR is less than the required rate of return. Okay, so these are the acceptance rules. Merits are used as accounting data with which the executives are familiar. Simplicity gives more weightage to future receipts. Demerits are obviously it ignores time value of money because it is a non-discounted cash flow technique. It doesn't use all the cash flows. No objective way to determine the minimum acceptable rate of return. Okay. Now comes the modified internal rate of return. Okay. So it is the compound average annual rate that is calculated with the reinvestment rate different from the project's IRR. So if you have seen the first video of NPV and IRR, the first part of the series, you will know that in IRR it implies that the cash flows are reinvested at the IRR rate itself. What is IRR rate? It is the rate at which NPV is 0. Okay. So in IRR, it says that the cash flows are reinvested at the IRR rate itself. But in MIRR, it says the reinvestment rate different from project's IRR. Here the reinvestment rate can be the cost of capital or the opportunity cost of capital or the required rate of return. Here the modified internal rate of return is a solution to the shortcomings of the IRR. There are two major disadvantages of IRR. One is multiple IRR problem and the impractical assumption of reinvesting positive cash flows at the rate of project IRR. Okay. Now MIRR is based on the assumption that cash flows are reinvested at the cost of capital or the required rate of return, and projects are financed at the financial cost of fund. It is a comprehensive method to calculate the IRRs of the projects with uneven cash flows. Okay, there was in uneven cash flows, IRR causes some problems, but in MIRR it gives a solution. Okay, so it is a comprehensive method to calculate IRRs of the project with uneven cash flows. There is a mix of more than one positive and negative cash flow. It is consistent with the NPV method and eliminates the problem of multiple IRR. Okay, that is the multiple rates. So this is the formula, future value by positive value under root over -1. Okay, so just know the concepts. You don't have to go into details because these are not much popular methods. The NPV, IRR, profitability index, payback period, ARR, these are the most popular methods. These are not such popular methods. Okay, just know the concept that MIRR is it reinvests the cash flows at opportunity cost of capital, whereas in IRR the cash flows are reinvested at the IRR rate itself. Okay, so MIRR have the is a solution to the shortcomings of the multiple IRR problems and the impractical assumption of reinvesting positive cash flows at the rate of project's IRR. Okay, just know the concepts, that will be enough. Okay. So thanks for watching this video. This is a new channel, Free Management Education. Do kindly like, comment and subscribe if you wish to. Okay. My email ID is given in the description box, and if you want some specific videos on some specific topics, feel free to comment or reach out to me. Thank you. Stay safe. Take care of your family.